Clay Patton on the Rural Radio Network. Let's take a look here at the weekly commodity trade with Darrel Holaday Country Futures in Frankfort, Kansas. Darrel, it is another back and forth week, but really it seems macro market factors are once again a big influence in this market without much USDA data, and that dollar index, it is just like a bouncy ball, up one day, down the next. Overall, what'd you make on the week's trade?
Well, yeah, we did see the back and forth. I think on the grain side, you'd have to say that we still the ranges have stayed pretty well defined. In the corn and the beans specifically. The wheat is still somewhat range bound, but the range is much wider, and it's not unusual for us to test both ends of the range in 1 week. We didn't really test the top end this week, but we still saw a lot of swings in the wheat market. And once again, one of the reasons I think the wheat market gets more volatility is because of the corridor, the Russian-Ukraine corridor, whether the whole Black Sea region, what's going to happen there. And there's optimism. We came to the end of the week by Turkish President Erdogan that he's optimistic it'll stay open, but there's just as many concerns that it won't, and the funds are trading the wheat pretty rapidly based upon they've got those algorithms that are sitting there watching the latest news and buying or selling. That's why I think you see the swings in the wheat, and yet, fundamentally, we still have issues. Firstly, the U.S. corn and wheat export markets are horrible, and that was accentuated this week by a wheat export sales number that was 160,000 and a corn number just over 400,000. That 400,000 ton number in the middle of corn harvest in the United States is just, see that low of a number for weekly export sales is just unheard of. But we're doing it because it's being driven where all the factors that we talked about last week are still there. The river levels are very low. We're not competitive. The Gulf, we're not competitive at the PNW with the world market, and as a result, we're not selling much. And the same generally is true in the wheat markets. But I think as we go through this situation, we go into next week, or the next 10 days, you're not going to be able to just keep speculating about this corridor, because at some point the people who own these ships they're supposed to be heading into the region next week or the week after will really hesitate if there's that uncertainty, because they don't want to get a ship in that area and then the corridor shut down. That's certainly negative financially. So again, the U.S. export pace for corn has been weak. The corn and wheat, the soybean numbers though somewhat active. We've seen a very active market the last 2 weeks. The export sales number this week was 2.3 million tons. Of course, we already knew about the 1.8 coming off of daily announcements last week. This week, the daily announcements were not as prevalent. I did see about 500,000 that did get sold, but that's generally a little slower pace. But overall, you have to be too worried about the soybean export pace at this point in time because it's ahead of a year ago on total commitments. But we also know that out there in the front, January and February, as we see Brazil off to almost a perfect start this year, a very aggressive planting pace because they have very good moisture, and they're way above their normal, or at least over the last 3 years, at planting pace. Now, Argentina's been dry and remains generally dry, but the forecast is much wetter next week, especially in the Cordoba region of Argentina. So that'll start picking that situation up. Now, most of the producers in Argentina have basically opted to wait and not plant corn until mid to late December, a later planted corn, which they did last year, just to avoid any of the dryness at this point in time. So that's really the fact that the South American situation is pressuring the soybean market on any rallies because of the anticipation that at least Brazil off to a great start and headed towards a record crop and offering beans already for that February time period. Palm oil supplies have peaked somewhat seasonally. We generally see those supplies tighten as we go down in February, March, so which saw some strength in soybean oil as a result of that. And the soybean meal market had really struggled the last 10 days, and it picked up at midweek with a big jump. And we'd seen a lot of DDGs that had been offered in the market out of the ethanol plants that had pressured the protein market because they weren't able to send those DDGs down the river for export. And so that was a pressure and influence for meal, but we saw some buying pickup generally at midweek. And as we came into the week's end, there's also optimism that we're going to see some rain come into the plains and the Midwest next week through Oklahoma. The models got wetter as the week came to a close. I will still say there's a lot of uncertainty, and when you've been as dry as this region has been, it's going to take a significant amount of saturation of the atmosphere to see any significant moisture, but the models were definitely wetter as we ended the week, so that was somewhat of a pressure and influence. Obviously, from Nebraska down through Oklahoma and Texas, they need rain, and if the models are right, there's going to be some, and we'll just see how that turns out. On the week, December corn down 7 cents, 6.84. March corn down in nickel on the week at 6.91. November soybeans 12 higher at 13.96. January soybeans up 12 at 14.05. December Kansas City wheat down 4 on the week at 9.48, and new crop July unchanged on the week at 9.40. So the swings back and forth, but as you mentioned, generally we end up not with no big changes on a week-to-week basis. November crude oil was down 66 cents at 85.05. Of course, the news this week, one time indicating that as administration is going to release another 15 million barrels of strategic oil reserve, that pressured the market at some point, but not really substantial. Matter of fact, as it was announced, we rallied into it because overall you're still not prompting a large amount of production, and that obviously with the releasing of the oil out of reserve, that there's those concerns trying to put pressure on the oil and the overall energy levels, and heating oil, and especially the heating oil side of things certainly moved higher as we came to the close on the week. In the livestock sector, sharply higher cattle and hog futures. Both markets continue to be led by the front end of the by cash strength. The cattle definitely a cash-led bull market that just continues to grind higher, which are always interesting markets. This hasn't been a fund-led. Funds haven't really participated in this strength. Matter of fact, the open interest has generally declined. But it's been just a supply tightness. The packers are finding very tight supply of choice and fed choice or prime cash-fed cattle, and the prices were up $3 this week. Again, it's very good to see that. We generally just simply ran into a hole in supplies that I think will last at least to the mid to late November, and the more it becomes apparent, the more we might try to pull cattle forward, and you might very well keep that momentum alive. As long as the demand holds up, so as you mentioned, the macroeconomic concerns are certainly there. They're very valid. There's several indicators indicating slowdown in the economy, continue to be slow, but at this point in time, the meats hold up well. The other thing I think should be pointed out is both the pork and the beef will be helped by the fact that many times when they find some strength, they look around the corner and there's some cheap chicken on the shelf. You're not going to see that. You got these high corn prices in the chicken production areas, high basis levels, high meal prices. A lot of this chicken's priced on formula. There's not going to be cheap chicken, it will be right in there with pork and beef higher. Matter of fact, the retail prices of chicken are reportedly up 30% over a year ago. So that will be supportive for holding the strength overall in the pork and the beef wholesale markets. On the hogs specifically, the index did hit a low of 92.76 early in the week, and then we moved higher. Now, it's not the surprise here is that we normally this time of year, as we're moving low, we just would continue to see this cash index move lower into mid-November, and we hit that low of 92.76. Generally thought that was the way it might be headed, but as a whole, things strengthened, the product strengthened, the cash value strengthened, and the market bounced off that index, and that bounced off of that low, and that rallied the futures, which were at a big discount to the index. On the week, October cattle 150.47 up 352. December cattle 152.42, 437 higher. October feeders 175.27 up 147. November feeders up 357 on the week at 178.35. December hogs up 6.88 on the week at 89.12, and the February contract up $7, closing at 90.52.
And that is Darrel Holaday, Country Futures, Frankfort, Kansas. Do remember that trading futures and options involve risk of loss, may not be suitable for all investors. Do consider these risks before investing. Learn more about Darrel and Country Futures when you visit countryfutures.com.